Hey guys, Britt here. Welcome to End Times Bible Prophecy. Make sure to hit the subscribe, like, and share buttons. Well, we've been talking about the global economy recently, and more importantly, the prospects of a global depression and financial crisis as we end this year and go into 2024. And when we've been doing that, we've been focused a lot on data from the United States. After all, the United States is the world's largest economy. The dollar dominates international trade, so that stands to reason. But I do not believe that the United States will be the epicenter of this financial crisis or this global depression. Again, it'll be global in nature, so it's going to hit every nation on the globe. But I think really ground zero is somewhere else. And we've discussed this before. And we shouldn't forget that that's the case. So where is this other place? Well, it is Europe, the European Union. Why is that? To me, there is number one reason above all, and that is energy, or to put it another way, lack of energy to be competitive on the international landscape the way they have been in the past. So let's look at this article right here. This is from Big News Network. It's titled, Why the EU's Economic Engine is Breaking Down. And this is specifically about Germany, long seen as the epicenter of the European economy. It says the energy-dependent German economy has been in decline since losing cheap Russian oil and gas. And that's really, again, what all of this is about. I cannot emphasize enough, there is a direct correlation between the amount of energy an economy uses and the amount of economic output generated by that economy. Put more energy in, get more output. Take energy away, output goes away. There's a very clear historical correlation between those factors. And so energy is the lifeblood of any economy. And as we've seen, with these high energy prices, the destruction of the Nord Stream pipeline, sanctions on Russian energy, all of these terrible policies, hey, let's shut down all of these long-running nuclear power plants that we've had. What a great idea while we're dealing with these other problems. That's not a great idea. It is going to have major economic repercussions, and that's what we're seeing as Germany has officially gone into recession. So this says the German economy, once Europe's roaring engine of growth, slipped into recession in early 2023 amid runaway inflation. The National Statistics Office revealed this week. GDP data is reportedly showing surprisingly negative signals, with the economy losing the potential for growth. RT looks at the challenges facing the EU's economic powerhouse. It says, why is Germany's recession important? Well, the EU's largest and richest member, Germany, has built its economic power on its manufacturing capacity, its integration into international trade, and a strong transport and logistics ecosystem. It is the world's fourth largest economy behind the U.S., China, and Japan. And I would add, they've also built that economic powerhouse on the back of cheap Russian energy. Russia is the lowest cost producer of oil on the planet. And Germany has been a direct beneficiary of that for the last 3 decades. That has now come to an end. It says, what is crippling the EU's economic titan? Post-pandemic supply chain problems and trade disputes, along with the energy crisis and aggressive monetary policy tightening, and we're going to get to that in a moment, have all placed a strain on the export-oriented German economy. Industrial production has stalled amid geopolitical tensions. And again, words mean things. Geopolitical tensions. There were geopolitical tensions during the Cold War, but it didn't impact industrial production. What they really mean to say is the sanctions, the policies put in place by Germany and those in the EU to sanction Russian energy, to implement all these green initiatives, shut down nuclear power plants, wage a war on coal and fossil fuels. All of these things have a direct impact on the price of energy and your economic output. So it's not geopolitical tension, but political decisions, supply bottlenecks, and a shift to green energy, which really isn't a shift to green energy. It's a shift to more expensive, less reliable energy. I need to add that in there. That was followed by a drop in purchasing power and diminished industrial orders. What's the major challenge for Berlin? The most important issue for the government is to sustainably serve the energy needs of the country's industrial base amid the green transition, again, which they are not doing because it's more expensive. You take away the government subsidies, it's a more expensive form of energy and it's less reliable. Plain and simple. Germany is one of the world's leading industrial nations, and manufacturing accounts for about a fifth of the economy, which for decades relied on cheap Russian energy to grow. And again, that Russian energy, it's no longer there, at least not cheap Russian energy. What is the impact of the sanctions? What has the impact been of the sanctions and the energy crisis? Among EU members, Germany has been the hardest hit by the side effects of Western sanctions on Russia, as flows of Russian natural gas have dwindled significantly. The sabotage of the Nord Stream pipeline, one of the main routes for Russian gas to Europe, has added to the woes. Well, that's an understatement. As a result, Germany no longer receives gas directly from Russia, having previously imported more than 50% of its natural gas from that country. Meanwhile, European wholesale energy prices reached unprecedented levels in 2022 as a result of sanctions on Russia, prompting fears of deindustrialization, particularly in Germany. And I would say, well, yeah, in 2022, they prompted fears of it. We have seen it. We're going to talk about that in a moment as well. It says, what other risks threaten Europe's leading economy? As a hub for industry, Germany is facing huge technological and political challenges. A lack of qualified workers is another major problem, forcing Berlin to further liberalize immigration. A recent study by the German Economy Institute showed that industries had more than 630,000 open vacancies for qualified workers they could not fill in 2022, up from 280,000 a year before. This is a problem affecting a lot of the world's economies. Where have all the workers gone? I have my ideas of where some of those workers have gone, but I can't say so on big tech media or I'll disappear. It says, is the EU's green energy push helpful? No, I can answer that one right off the bat. German manufacturers have been struggling to produce cars and factory equipment because of parts and labor shortages, as well as, and primarily because of, surging energy prices. Moreover, they're being forced to invest hundreds of billions of euros over the coming years to meet the bloc's new clean energy standards. The nation's automotive industry, by far the biggest in Europe, used to support hundreds of thousands of German jobs and account for over 20% of the nation's overall economic output. However, demand for German cars has been in decline amid the global shift toward electric vehicles. Well, why? Because they cannot produce them competitively relative to other countries because this cheapest source of energy is gone. Could German industry grind to a halt? Yes. Economists are predicting that the industrial sector, which has been the pillar of the German economy, will remain stagnant this year. Well, that's probably a best case scenario instead of the hoped for recovery, dampening the prospects of an economic resurgence. There won't be any economic resurgence anytime soon, I can assure you of that. And again, we'll talk about why that is soon. The outlook is grim as the transition to affordable, renewable power could still take years, if ever. I added that part, experts claim. Is the EU's powerhouse breaking down? The German economy, formerly a reliable engine for pulling the European Union out of crises, has turned into its weak link. Economists see German growth lagging behind the rest of the region for years to come, while the IMF has forecast it will be the worst performing G7 economy this year. Now again, why is this? Primarily, at the heart of all of this, there are a number of factors. An economy is a very complex system, but primarily we're talking about energy and energy policies. So Russia, the sanctions against Russian energy, the destruction of the Nord Stream pipeline, all this cut off flows of cheap Russian energy, but it's also these green energy policies that are turning toward more expensive alternatives that are less reliable and is shutting down nuclear power for no apparent reason when you're in the middle of an energy crisis. We're going to shut down these operating plants we've had for years, and I don't know where that energy is going to come from to replace that. So these ridiculous policies are causing this. And despite what the media wants us to believe, it's not going to get better anytime soon. We see articles like this, but we're going to delve a little bit deeper into this one. This one's on oilprice.com. It says natural gas prices could fall below zero in parts of Europe. So, when we look at what natural gas prices were 6 months, 8 months, 10 months ago in Germany and Europe, people would say, wow, they're going to fall to zero. Isn't that great? But I want you to think about, has something like this ever happened before you? Very recently, we heard about, oil prices went negative. I don't know if you remember that story from about 3 years ago. Very briefly, oil futures prices went negative, meaning the producer of the oil was paying someone to take it off their hands. Why? Because all the storage filled up. Why did that happen, and when did that happen? That happened in the middle of the global pandemic shutdowns that took place. So all this demand for energy, demand for oil in particular, went away from what it normally was, and all the storage filled up, and there was no place to put it. People knew they would need the oil, and the oil would be valuable 6 months, a year, 2 years down the road, but the system was constructed for it to be used then, and all available storage ran out, so it went negative. That wasn't a good thing when you think about what was happening in the economy then. And think about this. Think of, okay, is this a good thing we had record high natural gas prices in Europe just not even a year ago, less than a year ago? Now they're saying, it could fall to zero, which would be a record low. Right? This type of volatility, is that a good thing? I would argue it is not. And we're going to read between the lines in some of these stories here. So it says, as tepid, and I think this is the key, really, right here in the first sentence, believe it or not, because usually they bury these things at the bottom, and they bury some of it at the bottom in this one, I think. But right here, they get it. It says, as tepid demand for gas from power generation and industry has sent European natural gas prices into a free fall in recent weeks. Traders and industry officials are not ruling out the possibility that Europe may see a brief dip to below zero for day-ahead prices in some markets this summer. The combination of ample inventories at the end of a mild winter, steady imports of liquefied natural gas, and weak demand has led to 8 consecutive weeks of weekly losses in European benchmark natural gas prices, the longest weekly losing streak in more than 6 years. So I want you to think about, what did they discuss in the last story? Fears of deindustrialization. What do we read right here? Tepid demand for gas from power generation and industry, right? And weak demand. This is what's happening, guys. If you're running a company, particularly in the manufacturing industry, if it's an energy intensive endeavor that you're involved in, you're not going to say, hey, let's expand in Europe. Right? You're not going to do that. Even in the face of these ideas, these glowing, rosy news stories of, you're going to have zero. The price for natural gas is going to be zero this summer. Don't you want to expand your business? No. Businesses, what makes businesses thrive is certainty, not uncertainty. And so when you see this volatility, and when you see that the problems that caused those record high prices less than a year ago have not been solved. The reason we're seeing this talk of record low prices is because of two factors primarily. One, the second mildest winter on record in Europe, which is saying a lot because the records in Europe go back quite some time. But we're seeing this weak demand. In other words, companies are simply shutting down and moving somewhere else where they don't have these ridiculous energy policies where they go, well, you know, half of your natural gas was just lost and cut off. You had this huge pipeline explode. This is a real energy crisis. And yet we have decision makers who said, let's shut down our nuclear power plants. What a great idea, right? What a fantastic idea. Let's do that. And so if you're opening up a business, if you're investing billions of dollars in building out your operations, are you going to go to Europe? Are you going to do that in Europe? Or are you going to do that somewhere else where the energy policies are a little bit more predictable, where you can have reliable supply of relatively cheap energy? I think the answer is obvious, and as we read down through this story, again, they talk about all these things about these prices. Oh, it's so wonderful. And you have to read between the lines to see what they're saying here. But it says, thanks to a milder winter weather, reduced consumption on the EU level. Okay, this is what they were hoping for. Several months ago, we said we're gonna cut back. We're gonna take cold showers. We're gonna hope that we don't have a severe winter. Those things happened. But it says, and demand destruction in industry from the high energy costs. Europe made it through the 2022-2023 winter without gas shortages or gas rationing. But again, they did that due to demand destruction from industry from the high energy costs. In other words, deindustrialization, which is what we were talking about months ago when we saw this and said, this isn't going to turn out well, guys. This isn't going to turn out well. As we read down, they say demand for natural gas in Europe is now weak after the winter heating season ended, and peak summer power demand is yet to begin. Gas consumption from industry, which went through a very rough patch last autumn and winter, again, an understatement. Because if you remember in Germany, they had 4 companies that were over 130 years old. All 4 of them went bankrupt in one day, one 24-hour period. These were 4 companies in 4 different industries. They had all survived World War I, Weimar Germany hyperinflation, the rise of the Nazis, World War II, the destruction of Europe, all the things that have happened since then. But they all went bankrupt in one day because of these energy policies. So it says, so a rough patch last autumn and winter. Yeah, that's an understatement. It says, despite falling gas prices, industrial consumption of the fuel is not taking off. Let me underscore that. Despite falling gas prices. So they're saying gas prices right now are at least where they were before the Russian invasion of Ukraine. They're talking about, hey, it might go to 0 at some point this winter or this summer, but industrial consumption of the fuel is not taking off. Although it is possible that large industrial energy consumers wait for a further drop in gas prices, analysts say. Well, I don't need an analyst to tell me it's not going to happen for the very reasons we just talked about. When you have an industry crippled by these volatile energy prices and policies, you're looking for certainty. You're looking to be able to forecast into the future. What are my cash flows as a business? What can I count on? What are my expenses going to be? And you cannot make that determination in Europe right now the way you can in other parts of the world. So you're going to go to other parts of the world. You're not going to be looking at Europe as a place to expand you're going to be looking at Europe as a place to retreat from. And so I anticipate this getting worse, especially if the luck runs out this coming winter, because again, none of these problems have been solved. And again, we keep seeing all these rosy forecasts. So here's another one. It's from metals.com. European natural gas prices could slip into the negative zone. Based on multiple media reports, a trader said at the eWorld Energy Exhibition in Germany that as the price of natural gas plummeted to the level before the European energy crisis, the situation that producers have to pay buyers for natural gas seems to be becoming increasingly likely. Although this situation is very rare, it's not impossible. Previously, in October 2006, as the natural gas storage capacity in the UK reached 96%, and the Langled natural gas pipeline from Norway increased the supply, the local gas price once fell to a negative value. Continental Europe is now facing a similar scenario, with faster than expected inventory filling and significantly lower consumption. Why? Because their industries are shutting down, coupled with strong wind and solar power. Although the gas storage capacity of EU countries is higher than that of the UK, there is still the possibility of negative prices, but the probability will be lower. At present, the filling capacity of European gas storage facilities has reached about 66%, which is significantly higher than the level of previous years. Some expect the gas storage facility to fill up as early as August this year. As long as storage is full for a few days, we may see some single-digit prices. For now, ultra-cheap natural gas is not, just like the last article said, it's not boosting industrial demand, with some buyers delaying purchases, further weighing on the market. They're not delaying the purchases, guys. They're not going to be making them. They're moving their industries elsewhere. The fears of deindustrialization that they talked about in the first article we looked at are more than fears. They are reality. Europe is deindustrializing. It is contracting. You can't run a business with these inane energy policies in place, so you will take that business elsewhere. And guys, unfortunately, if you live in Europe, it's a lot worse than just an energy problem, as we have something else going on there as well. And I first want to turn your attention to this. So this is, we've looked at this in the past, this is the federal funds effective rate in the United States. So when you hear, oh, the Federal Reserve is hiking interest rates, this is what they're talking about. They're raising this effective Fed funds rate, which ripples through the economy and affects all the interest rates that are charged for things like auto loans and credit cards and mortgages and business loans that are made throughout the economy, help the economy take off. And again, we look at this and go, well, it's 5% right now. It's certainly been higher in the past. What's the big deal? Well, the big deal, as we pointed out in the past, is that when you look at the year-over-year change, going back over decades of data, you see nothing like this. This is unprecedented. We've seen an explosion that peaked at a year-over-year change of 5,612% in that interest rate. Now, back when I first pulled this up, there was a video that I put out called "The Next Crisis May Be Weeks Away. Here's Why." And at that time, we looked at this, and then we didn't see this going down yet because now the year-over-year is going off of the higher rate. But I said, there's no soft landing. This is the mountain. They're flying the plane into the side of the mountain. Something's going to break. The next crisis is weeks away. And that turned out to be true because weeks after we did that video, Silicon Valley Bank went bankrupt. And we, in quick succession, saw the second, third, and fourth largest bank failures in U.S. history. And I believe those are directly correlated with the chart we're looking at right now. But guys, as bad as this is, it's even worse in Europe. So let's look at the key European central bank interest rates. So here we don't have the same chart. I couldn't find a chart that would exactly match that. But a year ago, so we go back in time 1 year ago, prior to July 27th, when they hiked rates, you're looking at, so they had these three types of rates. You had the deposit facility, and these are the definitions of each of these right now, but they're basically, what is the available liquidity or credit from the central bank to the banking system in Europe? What are they paying for that? And how does that ripple out into the economy in the same way we were talking about with the Fed funds rate? So they had these three different rates. The first was negative, a negative interest rate, unprecedented. I'm unaware of any major economy that's had negative interest rates. But they had negative interest rates a year ago this time. One of the other three key interest rates here was 0, and the other one was 1/4 point. So now we're looking at 3.25, 3.75, and 4. So we've gone from negative to 3.25 and 0 to 3.75. Guys, those types of changes make this chart, they would make it look like a little bump like that, right? Because you can't even mathematically measure the same percentage change when you're talking about going from negative 0.5 point to 3.25. The math just doesn't work out. It's like undefined, but it's the equivalent of tens of thousands of percentage change. This is absolutely ridiculous, and it's going to cause something to break, just as we said with the U.S. doing the same thing. And so let's look at this article right here. This is from UPI. It says, EU financial sector resilient but fragile, European Central Bank official says. And I think that should be a clue as to what's coming, because essentially what we'll read here is the first sort of official denial from European Central Bank that there's any sort of problem. Oh, there's no problem. There's nothing to see here, right? That's an indication there's something to see here. So it says, right here, it says, efforts to control inflation in the European economy run the risk of creating vulnerabilities in the banking sector where conditions remain fragile, the vice president of the European Central Bank said Wednesday. The ECB highlighted potential economic risk in the May 2023 Financial Stability Review published Wednesday. Concerns about the health of the global financial sector emerged in the wake of the collapse of Silicon Valley Bank in California in March. Looming fears about a repeat of the recession from the mid-2000s spread to other financial institutions, leading to a shotgun wedding of sorts between troubled Credit Suisse and Swiss investment bank UBS. So if you remember that, Credit Suisse was considered a globally, systemically important bank. Their collapse would have caused contagion throughout the global financial system, a major crisis, and the whole thing would be falling apart right now if that had happened. It says, Luis de Guindos, not sure if I'm pronouncing that right or not, but it says, Vice President of the European Central Bank said Wednesday that efforts to keep prices stable are essential for a healthy market, though that could result in some collateral damage. Let me translate that. You and I are the collateral damage, right? It's not these guys. They're not talking about themselves. And he says, as we tighten monetary policy to reduce high inflation, this can reveal vulnerabilities in the financial system. So just as in the United States, they tighten the monetary policy in order to combat inflation. And what did it do? It revealed vulnerabilities in the banking system at Silicon Valley Bank, Signature Bank, First Republic Bank, Credit Suisse. He says it's critical that we monitor such vulnerabilities and fully implement the banking union to keep them in check. So, and then he goes on, he says, the banks in the EU have been resilient to the stresses witnessed in the U.S. and Swiss financial sectors, though policymakers need to ensure that resilience is preserved. Doesn't really say how he's going to do that. But then he says, banks, it was suggested, they may need to set aside more funds to cover any losses and manage their credit risk appropriately. So, well, isn't that the case all the time, that you would set aside funds to cover losses and manage your credit risk appropriately? So why are they even telling us this? Well, I believe they're telling us this because they telegraph these things in advance. When they know what's coming, they want to be on record as saying, well, I've said that it could happen. So when they're brought up before some government committee with a bunch of people shaking their fingers in their faces, they can say, hey, we said this could happen. It was a risk. It was a probability. It could happen, and it did. We called it, right? So he wants to be on record as saying he called it. If there's any doubt about that, we see it in this article right here. It says, ECB warns of hit to top European banks if, right, funds run into trouble. So here it says, the Eurozone's top banks may take a hit if their financial clients, such as funds, not really sure what's a fund, insurers and clearing houses, withdraw their deposits or otherwise run into trouble, the European Central Bank warned on Tuesday. Well, again, isn't that always the case that if your clients withdraw deposits or run into trouble, you could take a hit? So why is this different than any other time? Well, it's different because they're telling us, well, when we say take a hit, we mean collapse, right? So, but we don't want to panic everybody by saying, well, the whole thing could collapse. So we'll just say they could really take a hit if these things happen. The ECB study looked into the risk of spillovers from so-called shadow banks, such as funds. Again, what is a fund? What constitutes a fund? They need to be a little more specific. And other financial companies that provide funding in one form or another to traditional lenders and vice versa. Not really sure what they're talking about except for the financial system, right? So the financial system, there's a spillover from the financial system. It says the biggest risk it identified was that if shadow banks withdrew their funds from banks, such as deposits and repurchase agreements, these account for 13% of all traditional banks' liabilities, or more for larger banks. Okay? So don't worry, it's just, 13%, no big deal. It added that distress at systemically important lenders would also spell trouble for shadow banks. And see, when I read that, I'm like, well, isn't that obvious? But if you have distress at systemically important lenders, it would spell trouble for the shadow banks because, this is the part they leave off, because it would spell trouble for the entire global financial system, right? Because by definition, if you're talking about a systemically important lender, they're systemically important for a reason, meaning if they have a failure, if they have issues with their balance sheet, it causes contagion all over the globe. So why are we seeing these articles? Well, we're seeing these articles, I believe, because they know this stuff is coming for the same reason we knew when we saw this chart right here, something bad was coming, and then we saw the bank failures, and then we look at going from negative rates on up. They know this is coming. And here's one of the places where I think this is coming. Again, energy is a big issue, but I think we're going to see some hits to the banks here. It says falling value of commercial real estate likely to hit European banks, RBC warns. It says the European banking sector. So keep in mind, they're not saying this particular European bank, right? The European banking sector could be at risk from the weakening outlook for commercial real estate, analysts have warned. And again, if the European banking sector is at risk, if there's some sort of collapse there, well, we're going to see that on a global basis. In a note, Anke Reingen, again, sorry if I'm mispronouncing that, it says, analyst at Royal Bank of Canada argued that European banks are likely to take some hits from the worsening commercial real estate sector outlook. Commercial real estate has faced widespread problems in recent months as rising interest rates have dented valuations, which were already struggling to recover from the pandemic. A darkening economic environment and volatility in the banking sector has put further pressure on the sector. Since the beginning of March, the MSCI European Real Estate Index has fallen by nearly 10%. Many investors are concerned that declining commercial real estate valuations could pose a significant risk to financial stability in both the U.S. and Europe. And that is true because, guys, we haven't even seen the beginning of this. We're in the opening innings of this commercial real estate collapse and crisis in both the United States and in Europe. We're going to see why in just a minute because I think they get into that right here. It says Reingen argued that problems are likely to emerge as commercial real estate loans come up for refinancing. Around 30 to 40% of commercial real estate loans come off the end of fixed interest contracts within the year. These loans will have to be refinanced at higher rates. And the same thing is true in the United States. They're saying over the course of the next year, about a third of the commercial real estate loans are going to have to be refinanced. Keep in mind, they're going to be refinancing from really low rates. Back when a year ago or more, you're looking at these 0% rates from the Fed. So, what did they finance these buildings at 2%? 3%. Now they're going to be looking at 7 and 8%. And that makes it the cash flow projections fall apart. All the financials on this investment just fall apart. Not to mention, post-pandemic, there's less occupancy in a lot of these commercial real estate spaces. So the cash flow isn't there. And with the higher interest rates means the valuation is lower. So a lot of these firms trying to refinance this, they're going to have negative equity in the property. So think of what happened in 0809 when you had these residential properties. People had variable interest rate loans, and the interest rate went up. They couldn't pay it, so they were told, well, no problem. You just sell the property if that happens, based on the assumption that the property values always go up, but they had gone down. So now they're forced sellers, and somebody takes that hit, and it's going to be the banks here, guys. It's going to be the banks. And so then ultimately what? The taxpayers, because the banks will get bailed out. So ultimately it's going to be our currency. It's going to be you and me. But in the short intermediate term, it'll be the banks. We're going to see a crisis with the banks, this time from commercial real estate. It says, with banks looking to tighten lending in the next months, this could create a reinforcing negative cycle. So on top of all of this, and because of this, and because of the interest rates we were looking at before, credit is going to become much harder to obtain, which is going to slow the economy. It's going to be basically the definition of a deflationary spiral like we saw in the Great Depression. Until they turn this around and they open up the floodgate of currency printing, that's what we're going to see. We're going to see this self-reinforcing negative feedback loop that causes bankruptcies and a shrinking of the money supply and a deflationary spiral like the Great Depression. It says, however, European banks should be able to withstand even a severe shock. According to RBC data, commercial real estate lending makes up around 7% of European banks' total lending, whereas in the U.S., the figure among the largest 20 banks is closer to 10%. But of course, that assumes that all of this occurs in a vacuum. The wider economy doesn't enter recession or depression. All their best case scenarios come clear. We read all of this back in 2006, 2007, even into 2008. Oh, it's not going to be as bad as they say. These banks can withstand the stress test we've given them. Guys, don't believe any of this. This is telegraphing to us that they know this crisis is coming to a head soon. Exactly how soon, I don't know. Is it next week? Who knows? Later this year? I think for sure. I would be really surprised if we got to the end of the year and we haven't seen far larger financial institutions than what we've seen so far blow up. And keep in mind, in dollar values and in inflation-adjusted dollar values, what we've seen so far in 2008 and 2023 exceeds the 2008 bank failures. So it's already worse than 2008. Most people just haven't woken up to that fact yet because we haven't seen a stock market crash yet. We haven't seen a massive rise in unemployment yet, but these things are coming. We're heading into a global depression. I believe Europe is ground zero, but it's global in nature. The epicenter of all this is this fiat currency system that is a Ponzi scheme that's just going to fall apart. On the other side of this, the politicians, they're going to print their currency into oblivion because they don't know what else to do. The system is broken, guys. So be prepared. Be preparing. Again, what does all this have to do with Bible prophecy? Well, I believe it sets the stage, particularly when we're talking about Europe, for the rise of a demagogue, a leader, a savior who can promise an end to all the economic pain and social unrest that we're going to see. And that leader very well could be the Antichrist. I believe this all sets the stage for that. It also sets the stage for this solution to come out of central bank digital currencies. And if only we had these, we would be able to better regulate the system. We would know, we would be able to head off fraud, and we would be able, your bank would never go bankrupt. You'd never lose your deposit because it would be with the central bank. They're going to make all these promises, and they're going to be pushing people into central bank digital currencies, which sets the stage for the mark of the beast system, because in terms of function, central bank digital currencies are indistinguishable in function from and what they can do from the mark of the beast, even though they are not the mark of the beast, because the mark of the beast won't come until the midpoint of the tribulation. But make no doubt about it, guys, we're heading into this global depression, and it's going to set the stage for all of this to happen. So it's running long, but let me know what you think. Leave your comments below. Are you in Europe? Are you facing some of these situations? What are the energy prices doing? Are you seeing your utility bills go down? Are you seeing factories around you closing? Are you seeing stores around you close? What does the economy look like? I'm just some guy in the United States. Maybe I don't know what I'm talking about. Let me know if that's the case. Say so. Leave your comments. Again, all comments are welcome except spam comments. But if you disagree with me, that's fine. It's welcome here. So leave your comments below. Make sure to hit the like, share, and subscribe buttons, because that gets this video and other videos out to more people so that they can hear this message. But do all those things. Leave your comments below. And God willing, I will see you on Monday. Bye. If you want to learn more about the end times and Bible prophecy, make sure to sign up for my free monthly newsletter and get your copy of my free ebook, 7 Signs of the End Times. Just follow the link in the description to get your free book. Also, make sure to check out all of my books. Just look up Britt on Amazon, Barnes & Noble, Apple iBooks, Google Books, Kobo, or anywhere books are sold. Thanks for watching today, and until next time, keep your eyes fixed on Jesus, the author and perfecter of our faith.